Welcome back to another episode of Investing Explained. Here's today's question.
I love this question because I know whenever I was first starting to try to learn how to do stock investing and I was reading income statements and balance sheets and everything, I saw this figure, Goodwill, on the balance sheet, and I had no idea what that stood for. So Jesse's going to take the first stab at the question, and then we'll just kind of go around the horn and get some different responses. So go ahead, Jesse.
Yeah, this is a great question. And, Goodwill on the balance sheet, which is what I believe you're referring to, it mainly comes from, when a company makes an acquisition and they buy a company and they pay a price above the net asset value of that company's net assets. So, they pay with 100 million of assets, they pay 200 million. That 100 million of assets will go on the acquirer's balance sheet, and then 100 million will go into Goodwill on their balance sheet. To me, I don't, use those Goodwill numbers for anything when I'm looking at an individual company. It's interesting to look at those from the standpoint of, are the managers of this company good capital allocators? Have they made good acquisitions in the past or not? If they're regularly having to write down that Goodwill, then maybe they've made some bad acquisitions in the past, and that's something to pay attention to, that they're not doing a great job of allocating the shareholders' capital. Now, there are companies like Berkshire Hathaway who paid nothing for See's Candies, and they still have a little bit of Goodwill probably on the balance sheet for See's, but See's is worth incredibly, so much more money than they paid for it. Obviously Buffett is maybe the best capital allocator on the planet, but that's what I would look at Goodwill for, is to evaluate, is this management team good at allocating capital in terms of acquisitions, or are they doing a bad job and overpaying for companies? When you see companies that have a long-term streak of making acquisitions and then writing down Goodwill, that's a real big opportunity for some financial shenanigans in the statements and for them to hide some things and whatnot. Valiant Pharmaceuticals might be a good example of that. So, that's my take on Goodwill.
So I read a shareholder's letter from Buffett. He had a really fun discussion about Goodwill, and he talks about economic goodwill and he talks about accounting goodwill. And so what you're referencing in your question, you're talking about accounting goodwill and what that number represents. And so the way that Buffett framed the argument, or his point that he was trying to make, is he said, if you went onto the stock market and let's say you picked out one share of, let's just call it General Electric. And let's say that the book value for General Electric was, I don't know what it is, but let's just say it was $20 a share. And let's say that the market price, and you bought one share of General Electric, and let's say that the share was trading for, and excuse me because I don't know what the market price of General Electric, but I would guess it's, $30? If you bought that one share that was $10 higher than the book value, supposedly you have now been able to add $10 of goodwill to your acquisition of that one share. So what's really fun about the conversation that Buffett has is, you obviously don't do that as an individual investor, that you're now able to take that extra premium that you paid over the book value of the company and carry that now as an asset onto your balance sheet, your personal balance sheet. And that's the way that he described it. But when you're doing that as an entire business, that's actually how the accounting goodwill works. And so the thing that Buffett really wanted to get into with his discussion on this is that the accounting goodwill is pretty much worthless. Exactly what Jesse just said. It's not something that you can really place much value in when you're looking at a company as a snapshot in time to determine what the value is. But what you can value is that there is real economic goodwill with a business. So let me give you an example of economic goodwill. Let's say you go into a Walmart and you see a bin of DVDs there in the 50 DVDs sitting there. And let's say you're picking out a movie for one of your kids. And you're flipping through the thing there and you see that there's a movie from Disney. It has the Disney logo on it. And then there's some others that, you don't really necessarily recognize where they're from. A lot of the times people will go and buy the movie from Disney because there's this goodwill that's established with the customer, with the brand loyalty that's associated with economic goodwill. That has nothing to do with the accounting goodwill that you would mark up because you bought it at a premium to the book value of the individual share. So that's the discussion. So you have to determine that as an investor. What is the real economic goodwill that I'm gaining by owning this company through brand loyalty or whatever? That's my comments for it.
And I would just also make one other point is that, Buffett's teacher, Ben Graham, would say, I'm never willing to pay anything for that goodwill, that I want to actually buy a company for half of the value of its tangible net assets. And so, it's a very interesting discussion.
Yeah, and I think the discussion of goodwill really underlines how important it is to read through the financial statements and really understand them. Because if you're looking at a company and they might be reporting a loss, and you see all these write-downs in the oil industry, and you're saying this is a horrible sector, and yes, the sector might be punished for a lot of reasons, but there's a huge differences between the individual stock picks. So for instance, if you look at a stock like National Oil Vago, it looks like they've been punished, but the 1.6 billion write-off, that was on goodwill. So actually the company is still having positive cash flows, and they don't have a cash flow problem like other oil companies are doing. I also have positioned it myself, so that's not why I'm saying it. I'm saying it really to understand the accounting and how that works, and how something might be a write-off, but not like it doesn't influence your cash position on the cash flows for that company. And I think it's important to understand that Jesse, he also talked about See's Candy, Warren Buffett's famous acquisition, and he bought that 50 years ago or whatnot for, I think it was like $25 million. And it has a lot of goodwill now. So the way it works in terms of accounting is that if you have goodwill that's above the what is called the carrying value, so that's the value you see in the balance sheet, you can't write it up, but you can actually write it down. And that's what's called an impairment charge. So the management would every year go in and value the goodwill of that company and potentially write it down, not up. So that's why it's really important that you actually go in and read the financial statements and see how he really calculated the earnings. Is it because of the operations, or is it because of write-downs of goodwill, for instance? It's two very different things.
And it's important to note that the company gets a tax advantage whenever they would test it for impairment and write it down, which is a thing that you see a lot of companies do when they need to save some money on taxes.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.